All right, now we're live. All right, so my name's Chris Berry, certified LL attorney, certified financial planner with Castle Wealth Group, and we do these weekly wisdom webinars every Wednesday. And all I do is answer any questions that are either submitted live or submitted ahead of time via email. And if you do have a question, feel free to put it in the Q&A. I only have one question this week, so it might be a quick one if I don't get more. And I always start with positive focus, just something positive that's happened over the last week. And for me, soccer season started up again. So my daughter, she had 2 games this weekend, actually tied both. She played great. We played a really tough team so we'll take those ties, and the rest of the season should be easier since that was probably the toughest team in the league. So that was kind of exciting. Beautiful weather for both games, a little warm, but it was nice. All right, so we'll go ahead and get started. And I'm going to share my screen. Again, we only have one question that was submitted this week. Kind of a complicated one, though. So can you explain so what is tax loss harvesting, basically? And really what tax loss harvesting is about is direct indexing. So this would be a strategy that would only be used inside of non-qualified accounts. So we wouldn't do this inside of an IRA or 401k. This would be in like a brokerage account or a trust account where we have to worry about capital gains. If we're talking about IRAs or 401ks, we don't have to worry about capital gains because it's all pre-tax, and no matter what it's in, when you pull the money out, you're going to have to pay tax on it, and it's at income tax rates. So tax loss harvesting or direct indexing basically means the same thing. Or you have to do direct indexing really to take advantage of tax loss harvesting. Let's put it that way. So the concept is that instead of having like an ETF that is tracking the S&P 500, you have a collection of individual equities or stocks that are mirroring the S&P 500 with the idea that you're trying to mimic the performance of, say, the S&P 500 by having this collection of stocks. So it is another level of management, so a little more complicated. We do this for our clients in certain situations. You have to have a certain level of wealth for it to make sense, to really get a good bang for your buck. But the idea would be, and I'm just picking something right now. So let's say we're tracking the S&P 500, and we have like a computer stack. Let's say Microsoft. Okay, so as part of the S&P 500, as part of our direct indexing of the S&P 500, we have these individual equities. Let's say one of them is Microsoft. Well, what we could do, depending on the situation, if Microsoft drops, say, 10% in a year, we could sell at that point, lock in that loss, and then move into another computer company comparable, not exact, comparable, maybe Google. And I'm just using that as a bad example. With the idea that we're still tracking the S&P 500, but we've just exchanged one stock for another that is similar, but not exactly related. And then now, as it goes up, we're capturing the gains, and we already locked in that loss. So it is more of an active strategy, so a little more complicated. So we have to have the right amount of wealth to actually have a good bang for a buck, but it's a way to capture what we call tax alpha. And we have the capability to do that, and we do that in certain scenarios. And we can even run reports to show just what the benefit of that direct indexing would be. So hopefully that was helpful. Tax loss harvesting, again, it's where you're looking at direct index, you're trading out stocks at the right time to capture that loss or gain to make it as tax efficient from a capital gain standpoint as possible. And because really we're dealing just with capital gains, we're not really doing this inside of 401ks. Well, you can't do it inside of 401ks, but we're not doing it in IRAs or Roth IRAs, things like that. And you do have to have a certain level of net worth for it to make sense. All right, here's another question that just came in. And again, if you do have any questions, feel free to put it in the Q&A. So let me paste this one in, and then I'll share my screen. Oops. Try this again. Boom. All right, now let me share my screen. And here's the question. I'm 67, still have health insurance through my company. If I sign up for Medicare now, will it kick in? Well, I still have the other insurance. Should I wait until retire? You should sign up for Medicare, but don't take Medicare Part B, which is separate. That's more the health insurance side of things that you have to pay for. Now, typically, if you don't take Medicare by age 65, you're going to have a penalty, but the exception is if you're continuing to work and you have health insurance through that company. So typically, in most situations, if you have health insurance through the company, you continue to take the health insurance from the company until you retire at, say, 67 or even 70. And then you would flip over to Medicare, full Medicare, and there's no penalties because you had health insurance through your current employer. And it works similarly if we have a married couple where one spouse is working, the other spouse is not working, and the non-working spouse is over the age of 65, but they don't have to sign up for full Medicare if they're getting health insurance through the working spouse. So think of it like this: if you're getting health insurance through your employer, you don't have to sign up for Medicare or full Medicare. And typically you wouldn't want to, depending on your situation. And we do have a Medicare expert as part of our team. So if it's something that we want to have more detailed conversation, I can link you up with her. I know enough to be dangerous about Medicare, but that's how Medicare works. You don't have to sign up for full Medicare because you have it through your health insurance or through your employer. So it doesn't make sense to pay for both. You would just pay for one and figure out which one's better. Typically, it's going to be your employer sponsored plan. And so you'd stick with that until you actually retire. And then right away, you would want to file for Medicare. Okay. All right. That is all I got this week. If you do have questions, feel free to email them over. Otherwise, I'll see everyone next week. Thank you so much. Take care. Bye-bye. Bye-bye.